Something very strange is happening in the markets. While most people are watching the stock market, seeing names like Nvidia, Microsoft, and Meta hit new highs on the back of the AI boom, they are looking in the wrong place. One would think this means the AI revolution is proceeding without a hitch, funded by the endless profits of big tech. But the data does not support that. The real story, the one that could signal the next major shift, isn't being told in stocks. It's being told in the much quieter, more methodical world of corporate bonds. For the first time in their history, the tech giants building our AI future are making a fundamental change to their financial model. They've begun to borrow money on a scale we've never seen before, and the bond market, what many consider the smart money, is beginning to send some clear signals. The truth is, this is a major development that investors need to understand. For over a decade, the business model for big tech was a financial fortress. Companies like Alphabet, Amazon, and Microsoft were cash printing machines. Their massive profits comfortably paid for everything, and debt was largely an afterthought. They were the definition of an equity growth story. But the AI revolution has changed the entire equation. Building the infrastructure for artificial intelligence is astronomically expensive. So expensive, in fact, that for the first time, these companies' legendary cash flows are being stretched. This has triggered a fundamental change. The hyperscalers have started to shift from being funded by their own profits to being funded by borrowed money. It's a quiet but monumental transformation. If we were to look at a chart, we would see that the lines for capital expenditures and cash flow from operations are on a different trajectory than in the past. Analysts have noted that the rate of growth for capital spending is now significantly outpacing the rate of growth for cash coming in the door. Those lines are getting closer. This isn't just a minor adjustment. It's a complete flip of the script. These companies are no longer just asset-light software platforms. They are now behaving like old-world industrial giants, making colossal investments in physical infrastructure. And to fund it, they've turned to the bond market. The scale of this new borrowing is large enough to create a noticeable shift in the U.S. corporate bond market. We've seen a historic wave of new bond issuance from these hyperscalers, tens of billions of dollars in new debt to chase the AI dream. This isn't a niche corner of the market anymore. This new AI-related debt is becoming a significant portion of all new U.S. investment-grade corporate bond supply. What this means is that AI infrastructure is now competing directly for capacity in the bond market. Tech's weight in major bond indexes is growing, and this can have an effect on even conservative funds that are designed to track the market. But as this wave of debt has washed over the market, signs of strain have begun to appear. Earlier in the cycle, investors were lining up, and bond deals were massively oversubscribed. That enthusiasm, however, is beginning to moderate. The feeding frenzy appears to be over. This isn't a crisis, not yet. But it's a clear signal that the market's appetite is not infinite. Investors are becoming more cautious. So what is the bond market actually telling us? The message is one of caution, not panic. The market is repricing the risk of the AI build-out in real time, and the two clearest signals are coming from credit spreads and a financial instrument known as credit default swaps. First, let's talk about credit spreads. A credit spread is simply the extra interest that a company has to pay to borrow money compared to the U.S. government. A wider spread means the market sees more risk. And for some of the AI hyperscalers, those spreads have been widening. This is especially true for companies that are borrowing heavily to fund their capital spending. The reason is simple. A flood of supply from repeated large deals is testing the limits of investor demand. Furthermore, some of this debt is very long-term. Investors are starting to question the wisdom of lending money for 3 decades to finance an industry where technology can change in the blink of an eye. The second, and perhaps cleaner signal, is in the market for credit default swaps, or CDS. A CDS is basically an insurance policy against a company defaulting on its debt. When the cost of that insurance goes up, it means the market is getting more nervous, and the CDS market for some of these tech companies is flashing amber. The cost to insure the debt of companies that are taking on significant leverage for their AI build-out has been trending up. Ratings agencies like S&P are also watching this trend closely, citing concerns over rapid, debt-funded spending. To be clear, CDS pricing is not signaling an imminent collapse, but it is pricing in complexity. It's pricing in the risk of rising leverage and the sheer execution risk of this spending spree. So, does all this mean the AI boom is a bubble destined to pop? The answer is more nuanced. The demand for AI computing is very real. In that sense, this does not look like the dot-com bubble, where companies had no product. However, there is a bubble-like feature to what's happening. The risk is not that AI is fake, but that the industry is engaging in a massive cycle of overbuilding. The danger is that the capital intensity, the sheer amount of money being spent, outruns the economic returns. What if companies build all these data centers, only to find that monetizing AI takes longer and is less profitable than promised? That is the trillion-dollar question. For investors, the message isn't to sell everything related to AI. The message is to be smarter. Credit investors need to watch this relentless supply of new bonds. Equity investors can no longer assume these companies have indestructible balance sheets. That is now a variable that must be watched. For everyone else, the bond market has become an essential early warning system for the health of the entire AI narrative. The AI revolution has moved from being a story about software and code to a story about capital markets and debt. The hyperscalers are no longer just tech companies. They are now among the biggest borrowers and capital spenders on Earth. While the stock market cheers for the future, the bond market is doing the cold, hard math on the present. And its calculation is clear. The AI build-out is real, but it is not free, and it is certainly not riskless. The warning from the bond market is not one of imminent panic, but of rising complexity and growing risk. It's a warning that the easy money phase of the AI boom is over. And for anyone with money in the markets, that is a warning worth paying attention to.